Hi, everyone. Sorry, we are now back for part two of our discussion, and I want to take us back to our break-even analysis information again and kind of start this example over. I had to cut our discussion off very quickly before, and I apologize for that. But let's finish off the chapter. So we're looking at our example where we used information to determine the break-even point, meaning the break-even quantity for accounting, cash break-even, and the financial break-even. So our example back here was on investing $5 million today, and they gave us some selling price, variable cost, fixed cost information, and we needed to first calculate the sales volume so that there is a break even for net income is 0. And then what is the cash break even in quantity? And that was 100 units. So we had 200 units for accounting income break even, and then we have 100 units for cash break even. Now, the final one is the financial break even is where net present value is 0. Now, so 0 would mean that our cash inflows, the present value, are $5 million, the initial investment, because the cash outflow would be $5 million we pay out. We would need at the point where $5 million is coming in. So if we assume a required rate of return of 18%, what is the financial break-even point? Well, that is simply calculating for PMT in our annuity payments. So N is 5, I is 18 in my finance time value of money calculation. PV would be the $5 million, and then we would solve for the payment. So the operating cash flow from this would be $1,598,889, which is what we solve for. Okay, so that's where that $1,598,889 came from. So we would take our depreciation of 1 million plus the operating cash flow of 1,598,889 and divide that by the contribution margin per unit, or selling price minus variable cost, 20,000, and it would be 260 units. So now the question becomes, can we sell at least 260 units per year? Remember, that will cause us to have an 18% required return, or return on this investment, because that's where we want to be. Okay, so then we have to ask ourselves those questions and answer them, or look at our marketing and see, can we achieve the desired objective here? So on page 368, okay, there's some questions that are being asked, and these questions are being asked about the boat example that's in your book, but we can ask our same questions about this project. You know, how much confidence do we have in our projections? How important is the project to the future of the company, and how badly will the company be hurt if sales turn out to be low? What options are available to the company in this case? Okay, so these are questions that come out of these types of analysis. And once we see where we need to be at our sales, then we could feel more comfortable and confident as, can we achieve those? Can we achieve what we want to, and can we achieve that level of sales? Just bringing out information to us. Now, we've looked at how to calculate and interpret these break-evens for proposed projects. What we haven't done is what determines these points and how they might be changed. And that leads us into our next area of discussion, operating leverage. Operating leverage is the relationship between sales and operating cash flows. So on page 369, first paragraph in operating leverage, it says, generally speaking, projects with a relatively heavy investment in plant assets or equipment will have a relatively high degree of operating leverage. Such projects are to be said to be capital intensive. We need a lot of them. So it's a lot of operating leverage there. So the degree of operating leverage measures this relationship. So the higher the degree of operating leverage, the greater the variability in operating cash flow. The higher the fixed costs, the higher the degree of operating leverage. Okay. Degree of operating leverage also depends on the sales levels you are starting from. So again, the degree of operating leverage is the percentage change in operating cash flow relative to the percentage change in the quantity sold. So we can create a formula then that shows us the degree of operating leverage. So the measurement of that is equal to 1 plus fixed costs divided by operating cash flow. So we're showing fixed cost as a percentage of operating cash flow. So it's showing us how much fixed costs there are for every dollar of operating cash flow, because remember, fixed costs must be paid. So let's take a look at an example. Suppose sales are 300 units. This meets all three break-even measures. Okay, so it's it would be above break-even for accounting, break-even for cash flow, break-even financial. What is the degree of operating leverage at this sales level? So if we go back to our prior example on the project for $5 million, the operating cash flow is the variable cost minus the selling price times 300. Or you could have taken 25,000 selling price times 300 and subtract from it 15,000 variable cost times 300. In this case, they just took selling and variable cost, netted them together, and took one number, 20,000 times 300. Subtract from that your fixed costs, $2 million. So $2 million is the amount of operating cash flow. Now plug that into our formula. 1 plus fixed cost, 1 million, divided by operating cash flow of 2 million equals 1.5. So the degree of operating leverage here is 1.5. Now, what will happen to operating cash flow if unit sales increases by 20%? Okay. So the percentage change in operating cash flow equals, because we want to know what will happen, the degree of operating leverage times the percentage change in your quantity. So if our percentage change in our quantity is 20% increase and our degree of operating leverage is 1.5, the percentage change in sales, okay, would be, the percentage change in operating cash flow due to the change in unit sales and the DOL is 0.3% or 30%. So operating cash flow would increase by 30%. So they would increase to 2.6. So we're showing you how you can define the relationship, and then based on changes in your estimates of sales, excuse me, we'll show you what effect that has on your operating cash flow. Let's take another look before we go to the next one. So this will help us define what kind of changes then, and when a change happens in our quantity, how it impacts our operating cash flow. First, determine your degree of operating leverage using the formula we provided. And then you can calculate your change on operating cash flow using the degree of operating leverage times your percentage of quantity change. Finally, capital rationing. So capital rationing occurs when a firm or division has limited resources, which is all of them, okay? Soft rationing means the limited resources are temporary, often self-imposed, and they talk about them on page 372. So what's the big deal here? Well, you may have many projects that have a net present value that's positive, okay? And you may not be able to do all of them because you only have so much in resources. Well, soft rationing will occur when we say, no, we can't use this resource for this project. We can only use this much of our resources. So such an allocation is primarily a means of controlling and keeping track of overall spending. Corporations as a whole, it isn't short of capital, it has the money. More can be raised if management desired to. So there might be a selection of projects to be completed because they're soft rationing. Another is hard rationing. We just don't have the money for that project and we can't raise it. So hard rationing, again, business cannot raise capital for a project under any circumstance. For a lot of large, healthy companies, this probably doesn't even happen. Okay, it's usually soft rationing that causes a particular project not to be undertaken. So we just want to make sure it's clear that even though our projects might have a positive net present value, doesn't mean we're going to undertake them due to these kind of rationings the corporation has. But when we do have these kind of rationings, especially the soft rationing, it's the profitability index is a great tool to use to determine which project should be undertaken. And that was discussed in chapter 9. Remember the profitability index. Which one is going to be the most profitable of these great positive net present value projects? Which one will contribute the most in profit? Okay, so that is the discussion in chapter 11 and the tools that we use to fine tune our estimating, because that's what it is, it's estimating. And as we saw, net present value analysis is a heavy tool used for determining if a project should be used or should be undertaken or not. But focusing on scenario analysis so that we see more than one side of a project and looking at the present value given some different scenarios, and then testing different variables in sensitivity analysis to determine if they change a lot, their impact or change greatly, or even a small change. What's the impact on net present value? Then we take a look at our break-even analysis for accounting, for cash flow, and for financial. And using this, determine what is the adequate quantity we should be creating to meet our objectives. Keeping in mind that operating leverage plays a key component in determining how much cash flow will come out of a project, and also that capital rationing exists. So that concludes our discussion of Chapter 11. Please post any questions you may have to the, oh, let's do this first. Sorry, I forgot about our comprehensive project at the end, which is a great recap of the chapter. So you should shut this off after reading through it and getting the information, or just pause it and try this comprehensive project. And I'm going to take a look at it with you. We have here, project requires an initial investment of $1 million and is depreciated straight line to zero salvage over its 10-year life. The project produces items that sell for $1,000 each with variable costs of $700 each. Fixed costs are $350,000 per year. What is the accounting break-even quantity, operating cash flow at accounting break-even, and the degree of operating leverage at that output level? So you should see in front of you the answer. Okay, so first of all, our accounting break-even, remember, is our fixed costs plus depreciation divided by the price minus the variable cost of the product. So 350,000 is our fixed cost, plus take $1 million cost of the investment divided by 10 years. So that's 100,000 in depreciation. Divide that by 1,000 selling price minus 700 variable cost per unit. The break even for accounting is 1,500 units. So what would be the operating cash flow at 1,500 units? Well, we would take the 1,500 units. You can multiply that either by 1,000 and then subtract 1,500 times 700, or take 1,500 units times $300, because that's your contribution margin. Then subtract your fixed costs of 350,000 and then your depreciation, but then add back your depreciation because that's not subtracted for cash flow. So your operating cash flow at that level of output would be 100,000. So what would be your degree of operating leverage? 1 plus the fixed costs divided by your operating cash flow. So 350,000 divided by 100,000, or 4.5. So if units increased by 30 or even 40%, we figured, oh, we could sell 40% more in whatever we're selling here, these units. Well, what would be the operating cash flow change? 4.5. Right back here. Whoops. Okay. So it would be 4.5 times the percentage change, 40, or 1.8%. So operating cash flow would go from 100,000 times, that would be 2.8 to 280,000. You would use the 2 because they would stay. Where does the 2 come from? 1.8 is 180% increase. So we would have to take 100,000 would be once, and then add to that 180% increase. So it would be 100,000 times 2.8. So your operating cash flow would increase to 280,000. That wasn't asked, but that's how you would use that. Okay, so that was a nice comprehensive problem. And to wrap up the chapter. Okay, guys, now we're done with the rest of chapter 11. Please post any questions you may have to the discussion board. Thanks, everyone.